Hi guys, good morning. So today, like I mentioned, we're going to talk about three different topics: uh, asset management, risk management, and regulatory environment. Okay, so I should be able to complete everything in 3 hours. Okay, now let me start off by asking a basic question: is what is asset management? Okay, or what is your understanding of asset management? If anybody can, uh, you know, give me an insight, or what do you think is asset management? Any idea?
Maintaining the financial instruments and assets of the client.
Okay, maintaining it, I think, is secondary. Okay, what would be the primary? Managing. Okay, all right. Managing, fine. Okay, so when you talk about what is asset management, right? It is now. I want to be very clear here in terms of the terminology that I'm using. Okay, is that when you talk about asset management, it is the professional management. Okay, now who do we consider professionals in the finance industry? Somebody who is got the right qualifications to manage your assets. See, I've been working in finance for 15 years, but that does not make me professionally qualified to manage assets. Okay, so when we talk about asset management, it is the professional management of various securities and assets, okay, in order to meet a specified investment goal for the benefit of the investor, okay, or investors, okay. Now, there are essentially three types of investors, okay. High net worth individuals, basically people who have a lot of money, okay, movie stars and industrialists, etc. Retail investors, that comes down to you and I, and institutional investors, okay, hedge funds, mutual funds, sovereign funds, etc. These are your institutional investors, okay. Yes, sort of professionals like somebody who has a CFA or who has a MBA in finance. Okay, now I know a lot of you have an MBA in finance, but uh, the MBA that's generally taught here in India is very uh, theoretical. It's not a practical approach. Okay, all right. So, sort of, when we talk about asset management, what we're talking about is the professional management. Okay, so professionals are basically, they are qualified to manage assets for their clients or investors. Okay, and you have three types of investors: high net worth individuals, retail investors, and institutional investors. Now, let me ask you guys a question here: is that what according to you, what has been the most profitable asset in the last 10 years? So, if you had invested money in 2010 till 2020, for the last 10 years, what do you think has been the most profitable asset? Does anybody know? Real estate, equity, land, anything else? Okay. All right. So, actually, Saurabh, you got it right. Yeah. So, believe it or not, the most profitable asset to invest in the last 10 years is Bitcoins. Okay. Now, when you talk about Bitcoins, do you know what was the return on investment if you had invested in a Bitcoin in 2010? Does anybody know what is the percentage return? Any idea? Is it 10%, 50%, 100%? What do you guys think? Saurabh, I'm not able to understand what you're typing, man. Type properly. It is started on 21K. No, actually, it started even much less than that, Saurabh. No, no, it actually started, believe it or not, Bitcoins actually at one point they were trading at $1 for one full Bitcoin, by the way. Okay. So believe it or not, the most the return on investment on Bitcoins for the last 10 years. Anupam, actually, you're kind of close, but believe it or not, right? Is actually 9 million%. Yeah. 9 million% return on investment. Why? Because in 2010, right? Oh, sorry. In 2010, the Bitcoins were trading less than 100 US dollars. And when I knew about Bitcoins back in 8, 9, and all of that, right? It was like $1 each. And that was for one full Bitcoin, not even for like a small percentage of it. But me being me, I knew it was going to be big, but I didn't know how to actually get my whole hands on a Bitcoin and all of that at that time. And I was kind of lazy. And I honestly, this is one of my big regrets, is that I never invested in Bitcoins back in 2010. Now, why am I telling you guys about Bitcoins and all that is, I want you guys to have a different understanding of the term asset management. You are right. It is like equity, fixed income. You will invest in that. Okay. But derivatives is not an investment vehicle, right? It's not an investment vehicle. It's more of speculation and hedging. So, but Bitcoins, real estate, what else? Even art, antiques, and all of that, right? Is also considered as assets. Yeah, so Nikhil, I wouldn't say unorganized sector. See, basically, nobody knew what to do with Bitcoin, especially the government and all of that. So that's why they kind of banned it. But then, Bitcoin is going to be the future. So now they are bringing regulation around it. Yeah, as of now, there's no specific regulator, but it will fall under the banking regulator. And you know what happened in India? Like they initially banned it, okay? But then they realized, hey, you know what? Let people trade in it anyway, and we'll charge them taxes, right? Because government is in need of money, so they're just going to be charging and taxing the hell out of everything, right? Yeah. So yes, and you are right, Sorbis. Cryptocurrency is going to be the future. And if you guys notice, right, how many of you actually keep hard cash with you all the time? Most of us, including the chaiwala, now has a Paytm account or a Google app or Google Pay or whatever it is, right? So uh, the future is going to be all electronic. Now, it is both an advantage and a disadvantage. Advantage is that legal money is what it'll be very difficult to what do you call it, launder money. Okay, it'll be very difficult to launder money because everything it will be recorded and there's a clear movement of funds. Okay, but on the flip side, tomorrow, if you, let's say, do something wrong, they can freeze your assets and you will be trapped out of your money. Yeah, so that's the scary part. Yeah, yeah. Facebook has launched Libra, or yeah, but I haven't read too much about it, and I don't know what's the future going to be. So we'll see about that. But right now, Bitcoin actually has made a comeback in the last 2 weeks. But when we've missed the bus. So in case you find some other profitable asset, right, invest in it and do let me know as well. Okay. All right. Now let's talk about an example of an asset management company. Okay. Can anybody tell me what is an example of an asset management company? No, 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 no. Custodian, no chance. Yes, Prabhakar, BlackRock. But now, what is BlackRock? And it is an asset management company, yes, but it's a mutual fund, right? It is the largest mutual fund in the world. Do you guys know how much assets they manage? Okay, any idea? Believe it or not, since it's the largest mutual fund in the world, right? And they have basically a presence all across the world. So even in India, right? It is DSP BlackRock, and it's a great mutual fund, right? So uh, they have 1 trillion US dollars under management. So they have 1 trillion US dollars. Yeah, Vanguard is a really good other example. Uh, Even Goldman, by the way, has an asset management company. Interesting thing about Goldman was that they actually started an asset management business in India, but they ended up closing it down because the local guys, HDFC, SBI, all these guys, right? They have a complete monopoly in the market. So it's very difficult for foreign asset management companies to actually do business here in India. Yeah. All right. Now, when you talk about asset management, right, and an example of a company is a mutual fund. Now, how does a mutual fund work? I think a lot of us should be aware of it. Is that it basically pools money together by a large number of investors. Okay, now when I say large number of investors, largely the focus is going to be retail investors. Okay, retail investors are going to be the target for mutual funds. Now, why? Let me ask you guys this. First of all, actually, let me ask you this: is that how many of you actually invest in mutual funds? Okay, one person, two, three. Okay, that's it. Okay, fine. So okay, again, it's not. I'm not telling you guys to invest in a mutual fund, but it is highly recommended uh, that it's highly recommended that you invest in mutual funds. Why? Because mutual funds will give you returns better than a fixed deposit, and it'll help you to beat the inflation. Now, one of the biggest things about money, right, is that the inflation rate actually destroys the value of money, right? It destroys the value of money. So that is why it's very, very important that if you are going to invest in anything, so not only in mutual funds, but in anything, make sure that your that asset that you're investing in is able to beat the inflation rate. Otherwise, there's no point. You might as well just withdraw the money and keep it under your bed. Okay. So when you talk about a mutual fund, what does it do? It pools the money, or it collects money from a large number of investors, and largely the investors are retail investors. Okay, and they take that money and they invest it in the market. Okay, now why the focus towards retail investors is that, let's be honest, is that the stock market is very, very is actually unpredictable. A lot of us feel that it is predictable, but trust me, if you can predict the stock market, you can become very rich in a very, very short amount of time. Okay, but largely the stock market is not predictable at all. Okay, there are a few hedge funds. There is one hedge fund that has uh, it's a hedge fund from the 1980s called Renaissance, and that is the only hedge fund that has been able to predict the market about 39% of the time. And that 39% accuracy, right, is actually 100% accurate, right? So you guys should actually read about Renaissance hedge fund. It's an amazing story. And the guy who actually created the hedge fund is got a PhD in physics, if I'm not mistaken, right? So he set up that hedge fund, and it's doing really well, obviously. Now, when you talk about mutual funds, right, there are basically two types of mutual funds. Okay. Now, the broad classification is that it is based on their structure or based on their objective. Okay, based on their structure and based on their objective. Okay, so when we talk about based on their structure, basically there are two types, what we call as open-ended schemes and closed-ended schemes. Now, when we talk about open-ended schemes, what do we mean by this is that you can enter and exit the mutual fund anytime. Yeah, like you can invest tomorrow and you can withdraw it on Tuesday. That's fine. That's an open-ended scheme. Okay. Now, when we talk about a closed-ended scheme, right, this has a lock-in period. Now, what do I mean by lock-in period is that uh, once you invest into a mutual fund, you cannot withdraw it for a couple of years. Okay. A good example of a close-ended scheme is your tax savings mutual funds, right? So there is a lock-in period of generally for 3 years. Okay. And there are other types as well. Okay. But now let me ask you guys this question. Now, if you have a choice between open-ended and close-ended, which one should you choose? What do you guys think? Okay, open-ended. Now, again, it all depends on your perspective, right? But ideally, why you should choose close-ended scheme is that, well, according to me, you should invest in a close-ended scheme because what happens is when you talk about an open-ended scheme, right? Now, imagine this is a pool of money. Now, if I have investors investing, like giving their money, do I also not have people? So this, let's say, they're adding money. Now, what did I say? They can enter and exit anytime. Now, won't there be people also be exiting the mutual fund at any given point of time? What do you guys think? It will happen, right? Obviously. So then what happens to your pool of money? So if you have, let's say, a uh, let's say a $50 million, I mean, this is an imaginary number, so a $50 million mutual fund. Now, if it is a close-ended scheme, what happens? The amount of money that they are going to invest in the market is fixed. Okay. But with the open-ended fund, what will happen is that I might have 50 million one day, then it might shoot up to, let's say, uh, 80 million the other day, or it could even shoot down to 30 million in another day. So what happens is because the pool keeps changing, okay, yeah, because the pool of money keeps changing, right? The returns are going to be slightly uh, less than a close-ended, because in a close-ended, right, the amount of money is fixed. The amount of money is fixed. Okay, so that's the idea with a open-ended and close-ended scheme. Saurabh, I didn't understand what that means. 10 million in next day risk is there. So you're saying that, okay, tomorrow there might be a drop by 10 million. Is that what you're trying to say? Okay, cool. Saurabh, like, I'm not very good with like WhatsApp type texting. Type out the full thing. Yeah. Okay. All right. So that's your open ended and close ended scheme. Okay. The next one is based on their objective. Okay. Sorry. So when talk about based on their objective, right, you have many different types of schemes that are out there. There are literally hundreds and thousands, hundreds, I wouldn't say maybe thousands, right? But when you look at all the asset management companies, right, they have a lot of different schemes. But when we broadly classify them, right, you have an equity scheme, equity fund rather, a balanced fund, and a debt fund. Okay. Now, what do we mean by an equity fund is that if you invest 100% of your money will get invested in what? Equity. Okay. Now, even in this, you have, let's say, for example, HDFC top 100. So they will invest in the top 100 companies. Then you have, let's say, HDFC Pharma. They will only invest in pharmaceutical companies, etc. So 100% of your money is invested into into equities, and you can decide what sector or what kind of companies you want to invest in. Okay. Now, on the other side, okay, we have debt funds where 100% of your money will be invested in government securities, okay, government securities, and even maybe money market instruments. Okay, so these are the two extremes. Now, when we look at equity funds, right, these are generally considered as high risk and high returns. Okay. Now, don't. So when I say high risk, high returns, right? I'm not saying that they're going to give you like a 90% return on investment and all of that. Okay. Rather, what they're going to do is they are, and mutual funds is long term investing. So it averages down to maybe about 15% or 12% in a 30-year period. Okay. But why it's classified as high risk and high returns is that the equity market, right, as you guys have seen, can either shoot up, shoot down, and 100 points here, there, every single day can go up and down. So it's a very risky this thing, right? So Saurabh, good question. So see, depending on the scheme that you invest in, right, you will know what they're going to invest in. So for example, if you say HDFC top 100, okay, so they're going to invest in the top 100 companies in India based on the market capitalization. Okay. Now, if you say HDFC Pharma, right, yeah, like example, blue chip fund, or if you say HDFC Pharma, all the money will be invested into pharmaceutical companies. Okay, so that's the idea with equity. Okay, now debt fund obviously is on the other side, and this is the safe. This is relatively safe. Okay, nothing is 100% safe, and I just want to be very clear with that. Is your money is never 100% safe. Is money also safe with you? If let's say you got 10 lakhs in cash right now, you find it and it's in your hand, is it safe with you also? No chance. No, what are you going to do? You're going to spend it. You're going to spend and spend. Even I would do the same thing, maybe. Yeah. So, yeah, maybe demonetization might happen again, right? So, you know, nothing is safe. Okay. But should you take those kind of risks? I would say yes. Yeah. Because if you want to, let's say, have a comfortable life and you want to retire early, etc., right? Then you need to look at investing. Okay. All right. Now, the middle one is what we call as your balanced fund, where they will do 50% in equity, okay, and 50% in government securities and money markets. Okay. Okay. 60/40. Okay. Generally. Okay. Fine. So now, if we look at the 24 of us, 23 of us here, including me is 24, ideally, what should you guys be investing in based on your age? Should you guys be investing in debt funds, balanced funds, or equity funds? What do you think is the answer to this? Now, again, it's different perspectives, and there's no right or wrong answer. Okay, but largely this answer is driven by your age. Okay, now because you are young, you have more energy and you're able to work, right? Yeah, 100 minus age. There is a lot of math involved in this, but ideally what you should be doing is you should be investing in equity funds. Let's say the average age here is, like, let's say 21. So what you guys ideally should be doing is, from the age of 21 to the age of 40, you should be investing in equity fund. Okay, then you need to move from, when you're move from 40 to 50, you should move into balanced fund, right? And then uh, after your 50s, you should move into debt funds. Okay, so ideally that is one of the formulas that you can use. But then Vatsal is saying 100 minus your age. Prasad is saying 50, 30, 20. So there is a lot of different combinations. So for example, like, let's say you have I think 5K is a good amount to, like, invest in to a mutual fund on a monthly basis for you guys, right? So what I would suggest, and if we take Prasad's calculation, is, let's say 2,500 in equity. Okay, then what else? 1,500, that'll come to, then 1,500 into a balance scheme. So what do 3,000, 4,000, and then 1,000 to a debt scheme. So you can do this as well, right? Or you can invest your full 5,000 into equity. or balance or debt. So whatever, it really depends on you. So there is no right answer or wrong answer. Rather, the answer depends on you and your risk appetite. Okay, so that largely I feel is the correct answer, is that it all depends on your risk appetite. Okay, now even though I'm 38, right, I actually am a pretty big risk taker. Okay, I know I shouldn't be taking it, but I don't know, I'm a little nuts that way. So so I still invest most of my money into equity and all of that, right? So maybe as I get a little older, I'll move it out into balanced or debt and all that. But it's very personal, I would say. Okay, very personal, and there's no right or wrong answer in this. Exactly what's investment goals and risk appetites. Okay, so are we clear with what is an asset manager? So an example of an asset management company is a mutual fund. Okay, who are the target customers, what are the types of mutual funds, etc. Is this clear with everyone? Okay, perfect. Shall we move on to the next thing, or do you guys need time to write it? I would suggest that when I'm speaking, you guys write, so that will be easier. Shall I move on, or do you guys need a second to write it? Okay, good. Okay, let us write. Okay, fine. Quickly. Okay, done. Okay, all right. Digital India Fund. Yeah. But Watson, I don't know. I'm not a big fan of Tata actually. I actually like asset management companies like HDFC, SBI. I mean, SBI has been obviously around for a very long time, but HDFC, DSP, BlackRock. I not very like have a very good I mean, actually, maybe I don't know Tata too well. I'll be honest. Yeah. Okay, cool. But there's a lot that you guys can figure out on your own. But it's highly recommended that you guys start say investing your money. Otherwise, you will be working for the rest of your life. Okay. And I don't know about you guys, but I definitely don't want to work for the rest of my life. Okay. All right. Now let's look at the structure of a mutual fund. Okay. Now, when we look at a structure of a mutual fund, it's actually, well, it's pretty straightforward, but it's also complex in its own way. Okay. So when we talk about the structure of a mutual fund, what happens is that there are many, what I say, legal entities, and there are a lot of structures that are surrounding with the mutual fund. Now, when we look at the mutual fund industry, right, it is extremely regulated because because the money is from retail investors. So anytime retail investor money is involved, right, it has to be highly, highly regulated. Okay. And I'll give you guys an example, right? So every day, a mutual fund has to publish their NAV. Now, believe it or not, if a mutual fund misses to publish their NAV, right, they will actually be fined heavily by SEBI and RBI. Okay, and I'm not talking like 10,000 rupees and all that. Like a couple lakhs will be fined. Okay, so that's why it's very, very very, very strict and highly regulated. Okay. Now, when we look at the structure of a mutual fund, right, the first guy we have is the sponsor. Now, when we talk about the sponsor, right, it can be a person or a corporate body that creates a mutual fund. So, a very good example of this is HDFC, right? So, HDFC, if you guys know, initially, what does it stand for? Housing Development Finance Corporation, right? So when HDFC was first established, right, it's to give out home loans and all of that only. So that was their sector. But then they branched out into banking, insurance, mutual funds. What else did they get into? Trading securities, etc. So their business is into, and they're starting also in NBFC. So that's another line for them. So when we look at HDFC, right, they have sponsored HDFC AMC, Asset Management Company. Okay. Now the key thing with a sponsor is that they have to invest 40% of their own capital into the mutual fund. Now, why do you think this regulation exists that you have 40% of it to be invested into a mutual fund? What do you guys think?
Otherwise, the whole
Hmm.
mutual fund industry will go haywire and they will spend their money into the uh, very bad kind of assets.
Not necessarily, see, because it's regulated, right? They will not necessarily invest in bad assets. But the idea here is that, and let me guys give you a distinction or a parallel, is that all of you know how chit funds work. A chit fund, at least it's very popular in the south. I'm not sure about north. Chit funds, we all know how it works, right? So I'm not sure. Is it big in Delhi and all that, guys? No idea. Okay, even I'm not sure. Okay, so now when we talk about chit fund, how does it work, right? Everybody puts in their money, and you can withdraw it whenever, or you can hold on to it till the lock-in period. But then, what happens with chit funds is there are a lot of scams involved, right? And a lot of you guys would have been aware of it, where people would just steal the money and run off, right? Actually, next to my house, right, my neighbor, like many years ago, his daughter was running a chit fund, and they were doing it quite successfully. Okay, and one day they actually just disappeared. They took the money from everybody and they just disappeared, right? So now that's the problem with this. Okay, now let me ask you guys. Now let's say if I start a chit fund and I tell you guys, okay, guys, I'm going to invest 40% of my own money into this chit fund. Would you then be more comfortable with investing into a chit fund? If I, as a sponsor of the chit fund, am also investing 40% of my money, what do you guys think? Yeah, exactly. So this is the idea of the corporate giving 40% of their own capital, because then they can't take the money and run away, right? They can't take the money and run away. So that is the reason why a sponsor has to invest 40% of their own capital into the mutual fund. Okay. All right. Now let's. So once we have a sponsor in place, so is this clear on what is a sponsor and how it works? Right. So the next one is a trustee. Okay. Now the trustee, think of it like college trustees, right? Is that they ensure that the mutual fund will comply with all the regulations and also protect the interests of the investors. So otherwise known as unit holders. Okay. So you have your sponsor, you have the trustee. Next is the asset management company. Now the asset management company is the legal entity that takes all the decisions in relation to the in terms of basically it's a legal entity, and they are the ones who are going to basically, you will be working for an asset management company is the idea. Okay. Next you have the mutual fund custodian. Now please understand that even a company like Northern Trust, right, is also a mutual fund custodian. HSBC is, Standard Chartered Bank is also a mutual fund custodian. Why? Because for all these big asset management companies, right, or any asset management company, they have to have a custodian, because the cash and securities should always be kept with a third party. Okay. Why? Because tomorrow, if the asset management company goes bankrupt, the assets are still with the third party and safe. Okay. So that's your mutual fund custodian. And the last one is, not last one rather. So next you have the fund manager. Now the fund manager is the fancy person. He's the professionally qualified person who will invest and who will take those financial decisions. Okay. And generally you need to have a really good educational background to become a fund manager. Now, one thing, and I know a lot of you maybe have aspirations to be a fund manager, but you got to understand, maybe for the first 5 years, right, you'll only be selling mutual funds, right? And once you build up that client base, right, and then they see that you're serious, then they'll allow you to start taking decisions on investing and all of that. Okay. And the last one is registers and transfer agents. And what do? They do the record keeping and the administrative functions of a asset management company. Now, let me expand on this. Is that now, for example, let's say you buy a mutual fund, right? So it's your registrar and transfer agent who will process your documents, etc., and then they will submit that to the what do you call it? To the asset management company, or it's an internal team rather. So they basically do the administrative and all the paperwork related to a mutual fund. Okay. So is this clear with everyone on what is the structure of a mutual fund? So you have a sponsor and they invest 40% of the capital so that they don't run away with the money. Okay. Then you have a trustee, you have an asset management company, a mutual fund custodian, a fund manager, and a registrar, and a transfer agent. Okay. Is this clear with everyone? Okay. Take a minute, write this down quickly, and then we'll move on. Everyone done? Any questions on this? Actually, let's hold the questions till the end, yeah? Okay. All right. Now, let's look at uh, the opposite side of a mutual fund, okay? Um, so when you look at mutual funds, right, they are considered to be relatively safe because they're highly regulated. You have a lot of strict regulations that a mutual fund company has to adhere to. And also largely, right, they will only invest in securities. They will only invest in equity and fixed income, okay? And they're not necessarily going to invest in derivatives, okay? But on the other side of the asset management world, right, you have what we call as hedge funds, okay? So when we talk about a hedge fund, it is a financial institution, okay, that will protect the investor's money in any sort of market condition, right? Even if the market crashes, they should be able to protect their clients' money. But unfortunately, hedge funds, right? You have so many, especially in the US and all of that. But a lot of them don't do such a great job, okay? Because in 2008, right, all of them didn't really do a good job of protecting their investors, and they ended up going bankrupt, okay? But the idea of the hedge fund, right, is, and look at the word that's being used, hedge and a fund, right? So they should be able to protect your uh, what do you call it, protect your money in any sort of market condition, okay? They can protect your this thing in any sort of market condition, okay? So let's look at this. So now one of the interesting things about a hedge fund is that they guarantee returns, okay? Now what do we mean by guarantee returns is that because the investment capital, like the amount of money that you will have to invest, is very, very high. So generally the cutoff is somewhere around 10 million US dollars and above, right? $10 million and above. uh, what happens is that because the value of money is so high, they have to guarantee the return on investment. Okay, now does it happen all the time? Maybe not. Sometimes it does, or it's again unpredictable. But largely, when you look at hedge funds, right, they guarantee returns because the capital that is invested is very high, and the client base is going to be high net worth individuals and institutional investors, and these basically come out to be sophisticated investors. And the interesting thing about hedge funds, right, is that they speculate um, in derivatives. Derivatives, okay? Both exchange traded derivatives and OTC derivatives, okay? So that is the idea of a hedge fund, okay? Now we'll talk about the structure and all of that, but this is your brief introduction to hedge funds, okay? Okay. Any questions on this? Okay, quickly write this down. Okay. Quickly write this down and let me know. So, Saurabh, tell me what videos are missing, no? Because from my conversation with all of you guys is that all the videos are uploaded and there was no issue. So, and if there was, you should have let us know, right? But from my understanding, all the videos have been updated. Okay, so corporate action. Okay, see, I didn't take that class, so you guys need to email Kiran or Olga ma'am, and they'll do it for you, right? Or so it's just one video, right? So sort of, is it only one video or is it all the videos? But I don't think it's all the videos. I think it's just one or two. Okay, but anyway, we'll talk about this after class. So we'll see. I don't, because we're very diligent on that. So we'll see. We'll talk about it after class. Okay, are you guys done writing? So all these are excuses, right? So you guys should be see if you were in class. So anyway, we'll talk about this later. But this is my problem with all of you guys is that you're attending class, you're making notes. So and if you were doing this in classroom session, we don't have video. So then how would you have managed, right? So in my mind, it's just a reason that you guys are giving me that you did not prepare. Okay. Anyway, we'll talk about it after class. Okay. All right. So now let's look at the different types of hedge funds. Okay. So when we talk about the different types of hedge funds, so these are again based on structure. Okay. So first of all, we have what we call as a standalone hedge fund. Okay. When we talk about a standalone hedge fund, what happens is that the investor and the hedge fund is based in the same country. So, for example, if the investors are based in the US, the hedge fund is also based in the US, and the investing will also happen in the US, or will investing will also happen in the US markets. Okay, so everything is in one place. Okay, that's the idea of a standalone hedge fund. So there are also, by the way, hedge funds in India, right, that specialize in investing in Indian markets only. But when you talk about standalone, right, so you have an investor in India, the hedge fund is based in India, and all the investment decisions and all the investing will happen in India only. Okay, so that's the idea of a standalone hedge fund. Okay, now when we look at a side by side hedge fund, okay, now side by side hedge funds, and if you guys remember, right, so we said that to protect the investor in any sort of market condition. Okay, so when you look at a side by side hedge fund, right, is the idea is to protect the investors against country risk. Okay, now let me ask you guys this: is it possible for one country to be in a recession and another country to be booming? Is that possible? Yes, definitely it's possible, right? It's definitely possible, right? It's not, so see, like a 2008, yeah, that's one of those rare things where the entire world went into a recession and all of that. But on an average, the world is not in a recession, right? Well, maybe you're in a semi-recession because of COVID or whatever it is. But when we look at this, right, uh, a side-by-side hedge fund, what happens is that they have both a domestic hedge fund and an offshore hedge fund. Yeah. Now, what that means is that an investor, when they give their money, right, the money will be split across both the countries. So even if, let's say, the US market goes down, it's not necessary the UK markets will also go down, right? So if the one market goes down, there's a probability that the other market go up. Okay, so in UK I've given as an example, but for example, it can be India as well. Okay, so it can be an offshore hedge fund here in India where they're investing in the Indian markets. So that's the idea of a side by side hedge fund, is that the investors' money will be split across two different markets, so that even if one market goes down, it's not necessarily so. Even if that market goes down, it is hedged against another market. Okay, so that is what we mean by the different types of hedge funds. Is this clear with everyone? So standalone, the investor, the company, and the investing will all happen in one market. Okay, when we talk about side by side, the money is split between two different markets. Why? Because if one market goes down, it's not necessary that the other market will also go down. Okay, and I've given UK as just as an example, but it can be any other country. It can be India, it can be Japan, it can be China. And by the way, it's interesting to note that China's markets are actually going up, right? The stocks are doing relatively well, irrespective of how the US markets are doing, right? So that's the idea of a standalone hedge fund and a side by side hedge fund. Okay, is this clear with everyone? Yeah, so Saurabh, India was safe. India, well, I wouldn't say it is safe, because there is the Indian market is well, it's highly regulated and there's a lot of red tapeism. So that is why we were because of the red tape, we were kind of protected by the international market crash in 2008 and all of that. But I wouldn't say that, because India has its own set of problems domestically in terms of the economy, in terms of politics, in terms of skilled labor, ease of doing business, and all of that. Yeah. Okay. So any hedge funds in India? Well, there are hedge funds in India. I'm just hang on, let me check. I don't remember them off the top of my head actually. Hang on, let's see if I can. Hmm.
No, no, sir. I used to ask, are they domestic hedge funds or they are offshore-based investors?
No, so there are both. There are actually both. There are domestic hedge funds, and there are also what is this onshore, offshore hedge funds as well. But I don't remember the company names. Hang on, hang on. I'm just looking at it. So for example, Carvey Capital, right? They are a alternative investment company, investment fund, and they are classified as a hedge fund. Okay, IDFC, Tata Mutual Fund. Okay, maybe, but I'm not too sure about the hedge fund industry in India per se, because why it's relatively private, right? It's not made public information. Okay. Now, one thing that I want to clarify with all of you guys is that when you talk about hedge funds, right, it is high risk, high returns, because why they invest in derivatives, both exchange and OTC, etc. But the thing is, because it's privately managed and held, right? I wouldn't say it is highly regulated, okay, but it is less regulated compared to mutual funds. So there is regulation around it, but the regulation is less than the mutual fund industry. Okay.
So, hello.
Yeah. Who's this?
So by getting your point, standalone hedge fund comes under to ETD process, or side by side HF comes under the over the counter process. I think so.
It could be. See, again, when you talk about these hedge funds, right, they also invest a lot in securities, okay? But the main distinction, right? So I don't want you guys to think standalone will only invest in securities. No. So standalone will also invest in derivatives, OTC, even do currency, real estate, etc. But when you talk about a side by side, they split that money to two different markets.
So, for a new investor, those who are going to invest in the US market, I'm talking about the Indian investors.
Mhm.
So, which one is best, a standalone hedge fund or side by side HF?
So
For
if
a new
you're
investor, I'm asking to.
Yeah, so see, if you're a new investor and you want to invest in the US markets, right? You can look at Franklin Templeton US Opportunities Fund. Because what happens is that they actually take your money and they invest in the US markets. And that actually gives really, really good returns.
Thank you, sir. Thank you.
Yeah, so Franklin Templeton US Opportunities Fund, I think, is the name. And guys, there are two of you which you put your names as caller 01 and caller 02. Please change that. Otherwise, I won't be able to mark attendance. Okay. All right. Now let's move on. In terms of mutual hedge funds, right? One interesting thing about hedge funds, like I mentioned before, right, is that they guarantee the returns. Okay. Now the returns are capped. Now, what do I mean by capped is that they will say that, okay, I will give you 40% return on investment, but anything higher than 40%, the hedge fund will keep. So that's why you guys might have heard that, hedge fund managers, they make millions of dollars in fees and commission, right? It's because of this, right? So there essentially, when you talk about a hedge fund, there are two types of fees: a management fee and a performance fee. Okay. Now, when we talk about a management fee, what that is that it's the cost that the mutual fund or a hedge fund will incur to run the asset management company. So in India, you can consider that as your let's say exit load. Okay. So or your what is it? Sorry, not expense ratio, not exit load, expense ratio, right? So they charge you an expense ratio to manage your fund, right? So that is what we call as a management fee. Yeah, expense ratio. Okay. And then you have performance fees. This is only for hedge funds. Okay, this is only for hedge funds. And what happens here is that since a hedge fund will since the hedge fund will guarantee the returns, anything above the what do you call it? Anything above the guaranteed return, right? The hedge fund will keep. They will keep that as their profits, and this is known as a performance fee. Saurabh, there is no such thing as the trade economics of a mutual fund. Okay, trade economics only will come into, see, mutual fund is a company, so how will you have trade economics of that, right? So the trade economics will only be for your financial instruments, right? So equity, fixed income, etc. Okay, so is this clear on your management fee and performance fee? Okay, quickly write this down and then we'll move on to the last part. Sorry, Saurabh, I didn't understand your question. What do you mean? What put on mutual fund closed one is possible? Eh? What are you trying to say? See, guys, mutual fund is not a financial instrument. It is a company. It's an asset management company. So you cannot take a short put on a mutual fund. Is that what you're trying to say, Saurabh? I'm not clear. What are you trying to ask? What? Yes. Hmm. Okay, everybody done writing?
Sir, I have a question about this return on investment.
Hmm.
Hello?
Yeah, go ahead.
Yeah. When when hedge funds will guarantee the return on investment ROI, let's say it says 15 or 20% you'll get at the end of the investment.
Hmm.
So anything about the 20%, they will charge us performance fees. What if the funds don't perform well? I mean, up to 20% even. What if the funds gives 15% or 12%,
Yeah,
like below the 20%?
yeah.
Then where is the guarantee goes?
No. So see, it's under ideal market conditions. Under ideal market conditions, they'll guarantee that. But if it's an extreme case scenario, right? When it's an extreme case scenario, right?
Yeah.
Then they can't really do much. But ideally, that's the hedge fund. It's that they should be able to do it in any uh, market condition. They should be able to give out any return.
So it's
Hello.
guaranteed or depend on the market.
Yeah.
I just wanted to understand.
Yeah, exactly.
Okay.
Hello.
Yeah. Hello. Yeah. Yes, sir.
Sorry, sir, was not able to speak. That's why I was typing. But my question is that if I have invested in a mutual fund, so can it be traded in derivative market? For example, I purchase one and I want to sell in a higher price.
Sorry, say it again.
If I have invested in the mutual fund, which is trading at $1,500, something like that, and in future I want to sell it in a higher amount, so can I apply put option on that? That's my question. Because it's trading on the exchange, so I
No,
thought derivative market.
no, you cannot do that because see, you are not directly involved in the investment decision. Okay, it's the fund manager who will take those decisions. You are just giving the money. So if they want to hedge, they have to do it. You cannot do it. But if you're a direct this thing, then if you're directly investing, then you can do that.
But in
Okay,
active investment options,
so in equity it's possible because I am the sole, the
Exactly.
ownership is with me. Okay.
but in active investment options, you can take your own decisions regarding the investments in the mutual funds.
You can, but then how often do people actually do that? Actively managed. No, but no, hang on, no. Let me clarify. So when you talk about actively managed, what that means is that there's a fund manager who is managing your funds on a day-to-day basis. But you as an investor still don't have the authority to say where the money goes. Okay. So what happens is in actively managed is that there's an entire team analyzing every single day what's happening, where to invest, where not to invest, etc. But in a passively managed, they just dump the entire money into the index and they allow the index to grow. Or as the index grows, your return grows.
But in bank, when we are pitching the mutual funds, and we are told that you have to tell the customer that you can on your own handle your own mutual funds.
Yeah. No, but see, there what they might mean by that is that you can choose to switch your risk appetite or something along those lines. But when you talk about actively managed, there is a team of fund managers who will actively manage your portfolio. When we talk about passive, they will just put the entire money into the index, for example, and let the money grow into the index. Okay. All right. Cool. Now let's move on very quickly. Now the last part.
Yeah, thanks, Rakshit. I got it now.
Okay. Cool. Okay. Now let's look at this. The last part, right, is when we look at mutual funds and hedge funds, right? Because there is a large amount of money involved. The what do you call it? The mutual fund or the hedge fund, right? They cannot split the shares evenly. Now, let's say there's 25 of us here. Can I split the shares evenly among all 25 of us here? So let's say I bought, let's say 100 shares. Can I split 100, let's say 104 shares, okay? Or whatever it is. And can I split that evenly amongst all of us here? The answer is no, obviously, right? So that's when, so because you cannot split it evenly, right? What happens is that a mutual fund will not give you the shares or the bonds or whatever it is. Rather, what they will give you is they will give you the units. Okay, they will give you the units. Okay, so and how do you and these units have a monetary value, and that is what we call as NAV or net asset value. Okay, so when we talk about NAV, it is the price that you will pay to buy a mutual fund. Okay, now let's say the NAV is 50 rupees. Now, and let's say you bought and you want to invest 100 rupees, so you will get 2 units. Now, let's say after 6 months, that NAV goes from 50 rupees to 75 rupees, right? So now what happens is your investment value has gone to 150 rupees. Now, if you want, you can sell and make that 50 rupees as your profit. Okay, so that's the idea of net asset value. So when an investor buys into a mutual fund or a hedge fund, they will get units. They will get units. Okay, now how is NAV calculated is assets minus liabilities divided by the total number of outstanding shares. Okay, total number of outstanding shares. So when we talk about assets, what are these assets? These are your securities. Okay, both equity and fixed income, and any, or it could also be gold, cash, etc. Right? And your liabilities. Okay, I think I spelled it wrong here. Liabilities, it will be your expense ratio. Okay, and the total, and that you divide by the total number of outstanding shares. So what do we mean by outstanding shares? It is all the shares that are currently held by the mutual fund or the hedge fund, which keep either increasing or decreasing in value on a day-to-day basis. Okay, so this is the idea of NAV. Okay, quickly write this down, and we're done with asset management. I'm running a little behind, but then we'll catch up now with the other 2 topics. Okay, so finish writing this, and then we'll start the next topics. Good question, Vatsal. So in hedge fund ops, right, and also mutual fund ops, you have a couple of things that happen. Okay, first is okay, let me give you guys like a little bit of a story. So if you talk about a hedge fund, let's say, right, a worldwide hedge fund, and let's say they have their operations here in Bangalore or in India, for example, not Bangalore. I think there are a lot of hedge fund ops in Delhi. So what happens is that since they do worldwide transactions, right, what you'll have to do is once the trading is done for the day, right, once the trading is done for the day, you are going to do a valuation of all the either the contracts that they've entered into or the securities that they've bought. So you will figure that part out. Next is you'll figure out what they have sold off. Okay, because not only is it buying, but it's also selling. So you'll figure out what is sold out, how much cash is received, how much money has been paid or will get paid out. Okay, so you'll calculate all your assets. Okay, and also the costs that are incurred. So that's why you have your assets and liabilities. So we call this as NAV recon. So net asset value reconciliation. So you're going to reconcile all the assets in terms of what has been bought, sold, what's the cash on hand, what are the valuations of the securities. You will also do mark-to-market calculations, all of that. Then you'll figure out what are the expenses that they incurred on that particular day, okay, in terms of taxes that they paid or whatever it is, okay, taxes or the commission that they have to pay out to the brokers, etc. So all of this you're going to calculate. So that'll be your NAV recon. So you're going to reconcile all the deals that are done for the day. Then once it has been reconciled, then you will push it to the NAV team, okay, the team that calculates the NAV. So they will do assets minus liabilities divided by total number of outstanding shares. So see, the formula looks simple, but it's actually a very complex function, because these hedge funds and mutual funds, right, they trade in millions and millions of dollars per day. So then what happens is, once the whole thing is reconciled, you will then calculate the NAV, then you'll publish it to your client, okay. Now what happens is that sometimes there'll be a third party. Now let's say you are working for a hedge fund operations company. You will like, for example, Vitios is a good example of a hedge fund ops company. So they will do that, and there could be a third party like a custodian who would also do a hedge fund a NAV calculation, and you have to compare. Now if it's off, then there's a problem. You have to figure out where you went wrong and all of that, and you have to get that right. Then you have to submit it to your client. Now a lot of the, so if it's a mutual fund, it has to be published before, like, let's say 6:30, 7 o'clock local time of that market, because it's a regulatory requirement. So that's why getting into hedge funds is very difficult, because it is a very, very competitive and aggressive environment. Yeah. So you'll do NAV recon on one side, and then you'll do the NAV calculation on the other side, and get that published to the client and regulator on a daily basis. So it's a very important job, I would say. I mean, all jobs are important, but it's there's a high level of risk that is involved. Okay. Is that clear? All right, awesome. Okay, now let's move on. I hope you guys are done writing. So today, so we'll move on to the other two topics, which is regulatory environment and risk management. Okay, and we'll talk about regulatory environment first. Okay. Now, if I were to ask you guys a question, and I hope you guys know a bit about the 2008 financial crisis, is that if I were to ask you who is responsible for the 2008 financial crisis, what would your answer be?
Regulators.
Okay, regulators. But my question to you, Piyush, is, has the
Mortgage,
regulator
mortgage,
ever
because
admitted their wrong?
regulator not kept check on the subprime loans or the
Yeah,
small mortgage loans which banks are providing.
I understood that, Piyush. But let me ask you a question. Has any time a regulator ever come forward and said, "Hey, you know what? We made a mistake"?
No.
Anytime? Yeah. See, the regulator will never come. See, you are right to a certain extent that, hey, you know what?
But regulators on a while keeping check, they have to give the notices to the banks and all. But at that time, they also have not provided the notice and something like the
But you gotta
indication
understand.
that
Yeah.
something wrong is happening.
No, but you got to understand one thing, Piyush, is that when we look at the capital markets, right, it's very complex and it is constantly changing. So, let's say if I'm a hedge fund, I submit a report to a regulator, SEC, today, that report will be invalid tomorrow, maybe, who knows, right? So so when you look at who is responsible for the 2008 financial crisis, right? It's actually everybody in the financial system. It's not only the regulator, okay? Investment banks, the financial instruments that the investment banks created, like mortgage-backed securities and asset-backed securities,
Yes, sir.
the
Yes.
American economists, okay, and also the regulators. So when we look at the 2008 financial crisis, see, uh, uh, from a, what do you call it? Hang on, I'm trying to get the correct words. From a public point of view, okay, the general public point of view, eventually who took the blame for the 2008 financial crisis was the investment banks. Okay, the investment banks had no choice but to take it, because they were the ones who were selling the stuff that and they were also giving it to investors when they knew they shouldn't have done it, right? So that kind of ethics and morality or ethics wasn't really there. So at the end of the day, it was the investment banks that had to take the blame for the 2008 financial crisis. But the reality of it is that everybody messed up. Everybody dropped the ball.
So while recently looking at the series of 1992 scam, also it was shown that most of the investment banks were involved in that scam also, like the Citibank and American Bank and all.
Yeah. So that's what I'm saying, right? It's not so anytime any sort of major scandal happens, right? It is not one person's fault. Or let me ask you guys this question: when you look at Vijay Mallya and that Nirav Modi, is it specifically their fault? Did they
No,
cut?
sir. It is,
Yeah. So did anybody?
Whole system is
line of credit is provided by the Punjab National Bank and OBC along with the other financial
Exactly.
companies.
See, everybody has a job and they have rules and regulations and a process. But if people are not following it, can the regulator do anything? Right? The answer is obviously no. So when you look at who is responsible for the 2008 financial crisis, right? It is everybody. It is everybody that is responsible. Okay. Now, one of the first regulations that we're going to talk about, okay, and it's a important, all of the things that I'm going to talk about.
Sorry to interview routine. Actually, in every scam, all over were involved, but they want to target a name. So in 1922 take the name of Harshal Mehta. In 2008 they take the name of IBs. So yeah, the regulatory part can't take the entire blame on themselves.
Exactly. That's what I'm trying to say, right? It's everybody is responsible. Even you and I are also part of responsible for it, right? So, even I flew Kingfisher when it was very popular, right? So it's fine. It happens, right? But then you cannot say, so anytime a big thing happens, right? It is not the responsibility of one person or one this thing. It is everybody has to take responsibility. Okay. All right. Now let's get back into this. Is that so the first major regulation that we'll talk about is what we call as the Basel Accords. Okay, BASEL, Basel Accords. Okay, now Basel is basically a city in Switzerland, and basically there they have a committee comprising of all the central banks. Okay, and we call that as BCBS, okay, Banking Committee on Basel Supervision. So basically, the this committee focuses on the various risks faced by banks in the financial system. Okay, now when we look at the Basel norms, right, or the Basel Accords, it focuses on risk management guidelines on basically three types of risk, which is credit risk, market risk, and operational risk. Okay, it focuses on three: credit, market, and operation. Okay, so when we look at what do we mean by credit risk? What is the probability your client is going to default? Market risk, so if you are investing or you bought any sort of security or assets, have you properly hedged that? Okay, that's your market risk. And your operational risk is again human risk or your technology risk where people make mistakes, etc. Okay, now when you look at Basel norms, right, the key focus has been, and the latest Basel norms focuses on the liquidity ratio. Okay, now it's also known as the capital adequacy ratio, but it focuses on this. And basically, this ratio determines how much a bank can lend in the market. Now, why are they focusing on this? Is that when you look at the 2008 financial crisis, right, it was also known as a credit crisis and a liquidity crisis. Okay. Now, what do we mean by this? Is that the credit crisis or the liquidity crisis, especially the liquidity part, was that one of the main reasons why Lehman Brothers went bankrupt was that they did not have enough liquidity on their books. Okay, they did not have enough cash, or they didn't have enough safe instruments to protect themselves against a adverse market reaction. And I'll give you guys a parallel. Okay, is that when I was in Goldman back in 2005 to 2012, Goldman used to invest their own capital, and this was close to 40 billion US dollars of their own money in US government bonds and treasury bills and other very safe instruments. Okay. And it was like a joke on Wall Street that, hey, Goldman is wasting all their money, or they're underutilizing their money because they're wanting to be so safe. And other investment banks, I mean, it is a rule that you have to have some of your money in safe instruments, but Goldman always took it to the next level and was extremely cautious. But other investment banks like Lehman and all that, right, they were not so cautious. And when the market crashed, right, one of the reasons why Goldman was able to survive it was they had more than $40 billion in government bonds, which they were able to keep the company afloat. And believe it or not, by the time I left in 2012, that 40 billion had become close to 95 billion dollars of government bonds that they kept on their own books, right? So that was the idea of protecting themselves. Okay. Now, when you look at Basel Accords, it's been around for quite some time. Okay. So the first Basel Accord came out in 1988, and it focused on credit risk. Yeah. Focused on credit risk. Now, what do we mean by this is that, again, in the 80s, right, there was a real estate bubble that burst, and finally, it was Donald Trump and his entire this thing that was who was badly affected by it. But and at that time, right, a lot of companies went bankrupt and all that. So Basel came out on with regulations focused on credit risk. Okay. Then in 2004, Basel II came out, and this was after the IT bubble, information technology bubble. When that burst, they focused on maintaining the capital adequacy ratio, basically liquidity ratio, and having better risk management techniques. Okay. Now, unfortunately, 4 years later, whatever regulations that they came up with didn't really help, and they came out with Basel III, and the focus was on leverage, capital, funding, and liquidity ratios that a bank must maintain to be compliant with Basel. Okay. Now, when we look at these four, right, leverage, capital, funding, and liquidity, what this means is that when we talk about a leverage ratio, it limits how much a bank can lend or borrow in the market. Okay. So one of the reasons, I mean, multiple reasons are there why Lehman Brothers actually collapsed was that leverage, they had over leveraged their balance sheet by a huge amount. And it's like saying that, you know what, I have, let's say, 10 rupees in my pocket, but I went and I have borrowed 10,000 rupees in the market, right? Now, if everybody comes in and says, I want my money back now, and I have only 10 rupees in my pocket, I obviously will not be able to pay back, and I'm obviously going to default. So the focus on leverage was to limit how much a bank can use their leverage in the market. Now, when we talk about capital, it was to do with defining the capital structure properly, having tier one capital, tier two capital, and like a tier three capital. And all the tier one capital should be either in cash or very safe instruments. And when we talk about funding and liquidity, these go hand in hand. So liquid means that they should have enough liquidity on their books to meet all their payment obligations, and funding to ensure that they have enough money in their bank accounts to make all their payment obligations. So funding and liquidity go hand in hand. So liquidity is having assets, safe assets that they can sell off anytime to get the money to fund their payments to their clients and counterparties. Okay, so that is what Basel III currently focuses on. Okay, and I think in a while, and funnily, a lot of banks are still not compliant with Basel. I think most of the banks were supposed to be compliant by 2020, but COVID hit, and they said we can't do it, and then they said, okay, we'll push it to 2022 or something like that. Yeah, so currently Basel III is what is in place. Okay, so now I want to be clear with one thing. Basel Accords, right, is a worldwide regulation. Okay, So even India, right, is a member of Basel, and HDFC Bank is a member of is also Basel Accords compliant. Okay, so that way HDFC is one of the safest banks, is because they're not only RBI compliant, but they're also Basel compliant, right? And that's why if you guys have been seeing HDFC's bank's stock performance, it is outperforming other banks by a huge margin. Okay, so is this clear with everyone on what is Basel Accords? Okay, take a minute, write this down, and then we'll move on to the Dodd-Frank Act. This is it. There's nothing more down. First finish this, and then we'll move on to the next one. Yeah, Vatsa, that's the same guy. Read about him, your mind will be blown away. Okay. Let me know when you guys are done writing. All right, everybody done? Yes. Okay. Hang on 1 second. Okay. Sorry. Okay. Now let's move on to the next regulation. Okay. And one thing I want you guys to understand about regulations is that regulations will always come into effect after something bad happens. Right? So only when something, for example, the Harshit Mehta scam, after that regulations changed, after the, what do you call it, whatever scams that have happened, regulations have changed. Okay, so the next one that we're going to talk about is what we call as the Dodd-Frank Act. Okay, now Dodd-Frank are actually two people um, who are US senators, basically ministers of parliament type, and they came up with this list of regulations specific to the US market. Okay, now the idea of sorry. All right. So the idea of the Dodd-Frank Act, right? The objectives. So there are four main objectives, and the Dodd-Frank Act. Let me put it this way: it has been the biggest regulatory change. Okay, regulatory change since the Great Depression of the 1940s. Okay, so obviously there have been changes throughout, but uh, it has been the biggest overhaul of the US markets since the Great Depression. Okay. So, what are the objectives? Okay, is to promote financial stability of the United States by improving accountability and transparency in the financial system. Now, I want you guys to understand why would they use the term financial system here? Why do you think they are using the term financial system? Because when we look at the 2008 financial crisis, right, it affected everybody everybody from lenders to borrowers to banks to commercial banks, retail banks. I mean, maybe not so much, but investment banks, everybody, insurance companies, everybody, right? So that's why the Dodd-Frank Act was created to bring about a lot of transparency and accountability. Now, this accountability is very important because if there's a screw up, right, or if there's a mess up, there has to be people who are held accountable for, and largely that doesn't happen, right? It largely doesn't happen. Okay, and there have been a lot of scams in the past, right, where people have gotten away with it. Okay, why? Because it's considered as a white collar crime. So that is why a lot of times people don't get jail time for this. Okay, the next point is to end too big to fail. Now, I really like this term. Okay, and I think, I mean, there's also a movie based on this and all of that. But what is this idea of too big to fail? Is that if you allow something to get so big, right? What's eventually going to happen? It's going to fail. It's going to fail. Yes or no? Right? So what happens is that, so where this Dodd-Frank Act is coming in is that it's like saying that, hey, you know what? Here are our regulations. You cannot go beyond this box. We cannot allow you to grow so big, because if you grow so big and you collapse, you will bring down the entire financial system. Okay, you'll bring down the entire financial system. So that's the idea of this too big to fail. Okay, and the next point is to end bailouts. Okay, so basically, how did the U.S. economy or the banks recover? Was that the U.S. government gave them loans and those loans are from who? Taxpayers, right? And would you be very happy as a taxpayer that all your money went to the investment banks to bail them out, where at that time you probably don't have a job or you lost your job because of an investment bank? What do you guys think? What do you guys think? Would you be very happy with that? Obviously not, right? And believe it or not, right, in 2008, if you said that you worked for an investment bank and you were in the US, let's say, for example, Saurabh, right? If you, let's say, you were working in an investment bank in the US, and somebody came up to you, hey Saurabh, where do you work? And if you say, oh, I work for an investment bank, I work for Morgan Stanley or Goldman Sachs, what do you think would happen to you, Saurabh? Any idea? Will they say, oh, awesome? Yeah, exactly, Prasad. Yes, that's the right answer. You will get beaten up. Okay. And believe it or not, a lot of my colleagues, right, who used to work in the New York and London offices, right, they actually got beat up by the general public because they worked in an investment bank. Okay. So, and after that, right, it took a long time for investment banks. Yeah, yeah, seriously. Some were beaten up, some were attacked. I think there were also a few people who were killed as well. Yeah, it happens. So that's why one of the things that I always suggest that you guys do, right, is never talk about your job in public, right? Because you don't know who's listening. Well, that was long. If you want to, Saurabh, if you want to join an IB, you can. I'm not forcing you, right? But my general rule, and this was taught to me when I was at Goldman, is that I never talk about my work outside of the office, right? Uh, I never talk about what I do or what I don't do or whatever it is. So if anybody used to ask me back then, right, I used to say I work for a bank, and that's all. And I would never say I work for Goldman and all of that, because it's unnecessary. What do you call it? Stress. Yeah, so sort of in India, no, more actually, people will, if you join an investment bank, they're like, "Hey, refer me, man. I would love to work in an investment bank." But you gotta understand and see, it's like 12 years later, right? So largely people have forgotten and move on. Yeah. So so when I talk about my work and all of that, not a raw agent. So I actually have met raw agents in my career, and I've met special forces guys. They are really interesting and cool people, right? But they never talk about it. So I generally don't really talk about what I do. I mean, Marticus and all that, that's fine because it's teaching and all of that. But I generally don't talk about the work that I've done and all of that, because you know they don't need to know about it. That's where I come from. Yeah. So so the idea of the Dodd-Frank Act was to end taxpayer bailout. Yeah. And the last one, and this was also a very interesting thing, was that abusive financial services practice. Okay. Now, what do I mean by this, right? And those of you who work in retail bank, you know this, right? Your manager pushes you a lot and yells and shouts and screams at you to make a sale, right? Now, will you be like, if you were to be 100% honest with your customers, would you make a sale? What do you guys think? So, like Piyush, what were you were saying about actively managed and all of that? I don't think that's the right this thing. Yeah, no, you will not this thing, but you will have to kind of lie a little bit and all of that. And in India, especially, it's even more difficult because people don't like to be sold anything, right? And if once they feel that, oh, okay, you are being sold something, then they will definitely not want to buy, right? So but you got to understand that in the US and all that, because it's a sales driven market and economy, a lot of people would break the rules and regulations and all of that, and they would abuse the system. So that is why when the Dodd-Frank Act, DFA for short, was created, was to ensure that this was also part of the regulation. Okay. Yeah, Saurabh, I understand you. Sometimes you have to, but you know, yeah, Prasad. Very good point. Yeah. So Wells Fargo is also a very good example. The salespeople were so pressurized by the management, right? They used to the salespeople only used to make fake accounts, and they used to deposit their own money so that their manager would not bother them. Yeah. Now, obviously, in India, if you try to do that, everybody will get fired. But Wells Fargo, no, did a really terrible thing. Okay, now one of the things after the part of the Dodd-Frank Act is what we call as the Volcker Rule. Now, Volcker again is a person. I forget his first name, but he was one of the chief economists at the Federal Reserve, the central bank of the U.S. And the rule that he came up with was that for investment banks in specific is that they have to limit the kind of speculative trades that they take. Now, what do I mean by this is that sometimes investment banks, right, they were on both sides of the deal. They were both buying and selling to clients when they knew the asset quality was not that great, right? And they ended up making commission on both sides. So with the Volcker rule, it limits of how much in terms of dollar terms that a investment bank can do speculative trading. And an interesting thing is that they eliminated proprietary trading. Okay, now how I want you guys to understand this is that technically investment banks are not allowed to do proprietary trading. Now, what is proprietary trading? Is that the investment bank is using its own money to invest in the market. Okay, to invest in the market and get capital gains out of it, or capital appreciation. So now, because of the Volcker rule, they eliminated the proprietary trading completely. Okay, now how did the investment banks go around it? Was that okay, fine, we will not do proprietary trading, but we will spin off, and you guys did this in corporate actions, right? We'll spin off, we'll create a new legal entity, and that legal entity will do the prop trading for the investment bank, right? So that's how the investment banks came around, were able to go around that rule. Okay, but this is what the Dodd-Frank Act is, and these are the 4 points. Okay, so largely from an interviewing perspective, they are not going to ask you much, but they will ask you what are the big changes since the 2008 financial crisis, etc. So you can talk about the Dodd-Frank Act, for example. What are the cons of? So, good question, Anupam. So, what are the cons of proprietary trading? Is that, see, now let's say that Anupam, that you're an investment bank and I'm your client, and let's say Prasad is your another client. Okay, now Prasad will come to you and say, "Hey, you know what? I have some really terrible assets that I want to sell off. Will you buy it from me?" Now, you Anupam, you will, buy it from Prasad, but then as a prop trader, right? You will say that, "Hey, you know what, Raksha, this is a really good investment to invest in. Why don't you buy it from me?" Right? So what happens is that it kind of blurs the legal and ethical barrier of doing business, because the investment bank can be on both sides of the deal and make a lot of money, but the investor might be adversely affected. So that's the cons of proprietary trading. All right. Or you can look at it this way. So let's say that, for example, we'll talk about the mortgage-backed securities, right? Now, Goldman itself had a lot of Goldman and other investment banks, right? Sorry, don't want to say specific to Goldman, but all investment banks had a lot of mortgage-backed securities. And what happened was that they went out and they sold those assets that were losing value to investors who were not clear with it. So that could be considered as a con to proprietary trading. Okay, and why did they create that rule? Is that the investor is not cheated out of this. Okay, so good question. Wouldn't that be fed under bad speculation, even if an IB does that to one of the investors to gain profit? Yeah, but the problem is, Anupam, it's a really good question, is that a little bit of ethics come into picture, right? Now, Anupam, think about it this way. Now, let's say that you have a car to sell to me, and you know that the car is actually a very bad car, but you don't disclose that to me. Now, ethically, should you be doing this? Right. So that's why the Volcker rule came about, so that you cap the kind of speculative trading that they do, and also eliminate proprietary trading, so that the investment bank will not take undue advantage of their clients. Okay, good question, though, Anupam. Huh? Okay, good. All right, quickly write this down, or if you've written down, let's move on. You guys need time to write it? Okay, already done. Okay. Okay, everybody done? Yes, no? Okay, cool. All right. All right. So we did Basel, which was worldwide now, and we talked about Dodd-Frank Act, which was specific to US. Now let's talk about EMIR. Okay. Now, EMIR stands for European Market Infrastructure Regulation, and EMIR came into effect in 2012. So the Europeans, because you have the entire European Union, right? It takes a lot of time to get things approved, because they need a buy-in from all the countries, and got to make sure that one country is not adversely affected by a change in regulation. Okay, so when you look at EMIR, right, and it's very interesting, and they focused on one largely the OTC derivative market. And what they basically did, right, with EMIR is that they created EMIR to bring about stability and transparency in the OTC derivative market. Okay, now what's the objective is that all standardized. So when you say standardized OTC derivatives, right, so see, there's still customization and all of that, but I would say, let's say a standard OTC derivative contract could be like a forward contract. Okay, for example, so all standardized OTC derivative contracts should be traded on an exchange. Now, it will not obviously be traded on an exchange, but it will be recorded on a trading platform. Okay, so and we have all of this now after this, right? In the last 8 years, there's been a lot of technology development, but basically when you look at EMIR and companies that do OTC derivative tradings in European Union countries, right, what they have to do is that if they enter into an OTC derivative contract, they need to record that transaction with the regulator, okay, or an electronic platform, and the settlement should be taken up by either a CCP, a central clearing party, or even a clearinghouse. So even for clearinghouse, they've gotten a new line of business where they can settle OTC derivative contracts. Okay, so the goals of EMIR: OTC derivative contracts to be cleared through a CCP or a clearinghouse, derivative contracts to be reported. Now, who will you report this to? Largely the regulator. Okay, and also EMIR has created a framework so that the safety for central clearing CCPs and repositories is safe. Now, what does the third point means is that one of the big problems with the central clearing party is that in a worst case or in a severe market condition, what if a clearinghouse defaults? Now, touch wood, thank God that hasn't happened yet, but that possibility exists because of extreme market volatility at times, that a clearinghouse could potentially, default. So, and obviously you don't want that, right? So that's why they've created, so EMIR also focuses on that, is to bring about safety for central clearing parties and trade repositories. Now, trade repositories are organizations like DTCC, Depositories Trust Clearing Corporation, who also do a lot of settlement and clearing for OTC derivative contracts. Okay, is this clear with everyone on what is EMIR? So we did worldwide, Basel, Dodd-Frank Act US, and EMIR for the European Union. Okay, finish writing, let me know when you're done. Okay, everybody done? Okay, cool. All right. Now, the next thing that we're going to talk about, and I just want you guys to get right. So for risk management, right? I'll send you guys the notes because there's a lot to write. Okay. But I want you guys to write down the key points. Okay. And then I'll send you the notes for risk management because honestly, there's too much to write for it. Okay. Okay. So let's look at risk management. Now let's break up these two words. Okay. So when you look at risk, what do we essentially mean by risk? It is a situation, right? You're in a situation that could be dangerous to you or of losing of something of value as well, right? So, for example, let's say you're out, walking at night, and you see like five people walk out of a bar, and they are all very, energetic, and they look at you. What is your first reaction? I'm in danger, right? So maybe they won't do anything, maybe they'll do something, but you don't know, right? But that's the idea of risk, is that it is a situation that you know that involves some sort of danger. Now, that danger could be a physical harm onto you. It can also be an emotional harm. And largely, most of us are exposed to that kind of harm on a day to day basis, right? And if you talk about in terms of financial instruments and all of that, right, you will obviously lose value for it. Okay. Now, then when you talk about, then if we add the word risk and management together, we get obviously risk management. And what is the idea of risk management is that how do you effectively manage risk? Okay. Now, when you look at risk management, right, honestly, this is going to be one of the, well, it'll always be booming. I mean, irrespective, right? So risk management is a very, very integral part of any financial institution. And if you are a, let's say, good at assessing, identifying, assessing risks and all that, right? It's a great career place to be in. Okay. I personally kind of like risk management, but I don't like too much reporting work and all of that. Yeah. But when you look at risk management, right? So what is it essentially is that it's a process of identifying, assessing, and controlling threats to the organization's capital and earnings from, hang on, earnings. These threats or risks could stem from many different sources: financial uncertainty, legal liability, strategic management errors, accidental, and natural disasters. So, for example, right, COVID is a good example of an accident and a natural disaster, right? But strategic management errors, right? See, as humans, we're not perfect and we don't get the information right all the time, but our decisions, because they're flawed, right, could adversely impact the company's bottom line. Okay. And obviously financial uncertainty. Now, one of the things that COVID really taught us, right? How many of you, I mean, all of us were under strict lockdown, right? You guys didn't have to go to work and all that, right? Right. Now, what did the lockdown teach us, right? Is that a lot of companies are basically running on debt. Yeah, they're just running on debt and somehow they're able to manage. But when COVID hit and people stopped buying, right? Buying stuff that they didn't need and all of that, what happened? They went bankrupt. And especially in the US markets, right? Retailers, in shopping malls and all that, right? They went bankrupt left, right, and center, right? 150-year-old company retailers, right? They all went bankrupt, right? So, and another thing that you guys might have noticed is that how many of you were buying stuff during the lockdown, like going on Amazon and shopping, or Flipkart and shop. How many of you were doing that? I mean, it's okay if you were, but largely from my understanding and my personal experience, right? A lot of us didn't. Yeah. Oh, you guys did. Huh? Okay. Got good deals, huh? But largely, why a lot of us, well, at least I didn't do it, is uh, because I lived through the 2008 financial crisis. So I didn't know whether I was going to lose my job or not, right? So one thing that I'll tell you guys, right, is when you work in the world of finance, it's a great place to work, all of that. But what's the downside risk is that if tomorrow the markets crash, you might lose your job. That's the only risk working in finance, right? Now, because we're in India, your jobs are relatively safer, but then again, you don't know. Okay. And generally, and you guys might have seen, right, a lot of people lost their jobs due to COVID and all of that. But you got to understand one thing: will the company fire a top performer or a bottom performer? Please tell me that. Yeah, exactly. So all that you guys might have be seeing on, and again, it's nothing personal against anybody and all of that, but generally, when financial crisis has happened, right, the company will usually fire the bottom uh, spectrum. Okay, and I'll give you guys a great example, right? So when I was in SocGen, so SocGen's policy is we will not fire anyone unless they really, really perform bad. Then too, we have to put them on performance improvement plan and HR discussion and all this other, red tapeism. Okay, and but in companies like, let's say, Goldman Sachs, yeah, not only lower level management but even analysts and all that. But let me give you a parallel. What so is that when I was in Goldman, right, every year, from a managing director to an analyst who were identified as poor performers were automatically fired every year. Even a person who was there in a company for 25 years could be asked to leave because they were a bottom performer. Right? And here's the thing, they're not going to come put you on a performance improvement plan, all of that nonsense. They'll come to you and say, hey, you know what, great working with you, but we feel that you are not performing well, please leave. Literally, like I've a lot of my colleagues during the 2008 financial crisis, right, they were asked to leave the same day, and there's nothing much you can do about it, right? So that's the downside of working in finance. Okay, but yeah, so but it depends on the company and all that, right? But I think largely because I worked in Goldman for a long time, right, I actually prefer that, because you know automatically, and you know automatically where you stand. So if you know that you're in the bottom part of the bucket, there are two choices you have, or three rather, right? One is you can stay, work hard, and improve yourself, which I recommend everybody to do. Second one is quit, or third one is wait till you get fired, right? But ideally, you should never be in the bottom 10% of anywhere. And here's the thing, as managers, right? It's very easy for us to identify and all that. It's not only to do with your work, but it is also to do with your attitude, you being a team player, and all of those things, right? And like when I was in SocGen, right, I've had to fire people, give them zero hike, zero bonus in salary, and all of that. And there's no emotional decision. This okay, and a lot of people think that well, at least with me it doesn't work, and a lot of other managers it doesn't work nowadays. So that if you play politics and all of that, it will help you and all that. But COVID, right, really taught the senior management of who is doing the work and who's not doing the work, right? And those who played politics, now if your manager is not there to play politics with or in front of you, what will you do? Right? So a lot of people, because of that, they got fired and all that, because management was able to figure out, hey, you know what, this guy's actually not doing anything. Okay. Can be both, right? In terms of target they need to do and quality, which one? Well, see, Prabhakar, that's a good question. See, when you look at an investment bank, right? See, targets are largely sales. Okay. So when you join an investment bank, it is a lot to do with quality of work. Quality of work is what we look at, not the quantity per se. Because, see, for example, if you are in a reconciliation team, you might have to reconcile 1,000 transactions a day, right? So that's your job. But what I'm looking at is the quality of your work, right? So out of the 1,000 reconciliations, did you do 95% correctly, and at 5% you messed up? Now I'm okay with that, right? But IBs are not like number driven, but again, it depends on the team. Accuracy and quality is way more important than hitting a target. Okay, but for the guys who work in sales, for them it's important. Okay, but are we clear of what is risk and what is risk management now? Does this make sense? Yeah, exactly. So it can be automated and work from home. You know, and you know what? Again, it's not again specific to India, but worldwide, right? A lot of people have this mindset that okay, if you come to office, you will work more, but if you're at home, you will work less. But how many of you during lockdown worked more at home than at office? Exactly. Even me too, right? So there have been times when I started class at 9 and ended at 9, right? And here's the thing, you have no choice during COVID and lockdowns and all that, right? You had no choice. Now, what happens is that, and that's what comes back to my previous point, is that at that time management was able to see, hey, you know what, this person is actually doing the proper job, and this person who's been just talking and doing drama and all, I don't want this kind of person, because you know what, they're not actually working. So those are the kind of people who are actually kind of more or less gone. Okay, and again, nothing against them and all that, but largely this is the what do you call it? This has been the trend that we've been seeing with my friends and colleagues at investment banks. Ah, awesome, Saurabh. Good job. Yeah, me too. What from we went into lockdown in April, right? From April to literally April, May, June, July. I think for 4 months, right? I actually worked 7 days a week without a break, right? So now I think a lot of people understand it. Yeah. All right. Now let's the next part that I'm going to talk about, right? I'm just going to go through it very quickly, and I'll anyway email you guys the notes. Okay. It's the types of risk faced by a financial institution. Okay. So first of all, market risk. Now, what is market risk? Basically, you bought a particular financial. Let's say you bought 1,000 shares of Infosys. Now, what is the risk associated with that? The share price going down. So market risk is the changes in the value of the security or a portfolio. Okay. Now that's your market risk. Now you have price risk. Okay. Now when we talk about price risk, right, what we mean by this is that there is what we call as a general market risk and a specific market risk. Okay. Now when you talk about general market risk, right, it's like tomorrow Nifty tomorrow crashes by 1%. That's your general market risk because of negative outlook or some drama with the US markets, etc. Right? So that is one, your general market risk. The entire market crashes tomorrow. Okay. Now, when you look at a specific market risk, now let's say you bought Infosys shares, and let's say Infosys does very badly in their Q3 results. So what will happen to Infosys? The stock price will go down. So that's the idea with price risk. It is general market and specific market. Okay. Next is interest rate risk. So if interest rates go up and down, okay, so it could be even FDs changing, right? Generally, what we've seen is interest rates are actually going down in the Indian markets, right? And that obviously has adverse reactions. And if you look at international markets, when LIBOR changes or fluctuates a lot, then that's an interest rate risk. Okay. Equity price risk. Again, now we're talking specifically about equity and prices going up and down. Yeah. So these are the first four: market risk, price risk, interest rate, and equity price risk. Okay. Just write down market, price, interest rate, and equity price risk. That's enough. Okay. I'll anyway send it to you guys. Okay. All right. The next three is your foreign exchange risk. Okay. So changes in the exchange rate, right? So if you guys have noticed USD INR, right? So it has actually appreciated. So at one point it was at close to like 76, 77. And now it's actually come down to about 73, okay, or 74. So that's a good thing, maybe or maybe not, right? But changes in the exchange rate is also a risk for importers and exporters. Yeah, close to 74. Oh, nice. Okay. Next is commodity price risk. I think this we all have exposure, right, to commodity price risk. So one day onion prices is going to be 10 rupees for 5 kgs. Next day it's going to be 200 rupees for 1 kg, right? So that's your commodity price risk. Okay. And largely why it happens in India, I guess you guys already are aware of it, is because there's a big what do you call it? Like the unorganized market, right? They are heavily involved in this, and they control the supply of the commodities that are coming in and out of the market. So that's where the impact on commodities happen. Yeah. Next is credit risk. Now, credit risk, like we mentioned before, is counterparty default risk. Yeah. So you enter into a contract, and what if your client, defaults? Okay. So FX, commodity price, and credit risk. Okay. All right. The next two is, and we talked about this previously, is your liquidity risk. Okay. Now, when we talk about liquidity risk, right, there are two types of liquidity risks, what we call as funding liquidity risk and trading liquidity risk. Okay. Now, when we talk about funding liquidity risk, this has to do with being able to meet your payment obligations to your client and counterparty, and having enough liquidity in your bank accounts to do that. Okay, so this is purely a cash part of the liquidity risk. Now, when we talk about trading liquidity risk, what that means is that, now let's say that a company has negative news on Monday, okay, and everybody wants to sell off their shares. Now, if you, let's say, own 100 shares, will it be easy to sell it off? If you had 100 shares of a company that had negative news and you wanted to sell it tomorrow, could you do it? No. Actually, you can't sort. See, 100 shares is nothing, right? So if there's negative news about the shares, somebody might think, hey, you know what? Share price will eventually go up. So a good example would be the Satyam scandal, right? So Satyam share price tanked from like 100 to 10 rupees, but there were a lot of people buying it at 10 rupees, thinking, hey, you know what? It'll eventually go up, right? So, but now let's say if you have 100 shares or 1,000 shares, then it's not going to be a lot. Yeah, Lakshmi Vilas Bank, okay, recent one, okay. But now let's say you had 10 lakh shares of Satyam. Then what's going to happen? Then could you easily liquidate 10 lakhs?
Very difficult to sell.
Yeah, very difficult to sell. So that's the problem with if you own a large number of shares, right, and the market tanks or the company stock price tanks, right, then you're in trouble, right? So that's the trading liquidity risk. So funding is purely to do with cash, but your trading is to do with financial instruments. Okay, is this clear with everyone? All right, the next one is the legal and regulatory risk. Okay, so when we talk about legal and regulatory risk, right, it is changes in the government, the changes in the laws or the regulatory changes that happen immediately. And I think good examples of that, right, especially in India, was implementation of GST overnight. I think that caused a big shock to the financial system. Then what else? Demonetization. Demonetization, right? That was also a big legal risk, where they just basically said, you know what, all the money that you have right now is worth nothing. So then, became a big problem. So now, when we look at legal and regulatory, right, so a lot of it doesn't happen overnight, okay, but in rare cases it does, okay. But India has been quite an exception by doing stuff like this overnight. Yeah. Okay. So are we okay
Sir,
with?
I wish to ask a
Sorry.
question.
Yeah.
Whenever there is a confrontation with China in Indian territory, then also there is a lot of volatility in Sensex and Nifty. So, in which of these risks it will come, or it's just a movement?
No. So see, that is fear. That is fear. That is pure fear that, hey, what if India and China gets into a war, right? And because that possibility might exist, right, people are going to panic and say, hey, you know what, if that's going to be a problem, it's going to hurt the economy. And by the way, war, right, it depends on what kind of side you are on. So if you're a manufacturer of weapons, like let's say I think BHEL and all that, they manufacture weapons for India, right? So then those stock prices will go up, okay? But other services will come down, right? Other services will come down. So, oh, HAL, yeah, thanks. Yeah, HAL, yeah. Actually have a friend who actually works in HAL, and he was instrumental in developing the light combat helicopter. This thing. Oh yeah. But so, what's it, to answer your question? So when those kind of things happen, right? That's more of a politics that is coming to play, and also it's fear that's driving the market. Yeah, not to a crash, right? Prasad, it wouldn't be a crash as such. It'd just be a momentary downturn. Okay. Now let's be honest. Like, see, none of the countries in the world can afford to get into a war right now. if they do that, right, the entire country will go bankrupt in a short amount of time because wars are very, very expensive. Yeah. Yeah. So slight volatility, yes, but not a crash. Cold War comes in regime of legal risk. Probably. That's a good point. I think it could. Yeah. Pharma is doing really well. My pharma stocks, I'm very, very happy. A lot of my investments, right? So one of the things, right? So when I was in Goldman, we have strict regulations that you cannot buy shares and all that. So in 2008, I couldn't invest in anything, but I promised myself that in the next big crash, right, I will invest. So that's what I did when the markets were crashing, right? So I went out and bought a lot of, I wouldn't say a lot, but I bought a lot of different companies whose stock price crashed. And I'm very, very happy with, believe it or not, one of my stocks, right, has given me 105% return on investment. So I'm quite happy with that. Yeah. And my others are giving me like 40, 35, 40% on an average. So I'm quite happy. And farmers, again, doing well. Okay. All right. Now let's. No, not next fund manager. Actually, believe it or not, actually, so one of my students from a couple of years ago, he's actually been teaching me. So he's really, really good with analysis and all of that. He's the one who's been teaching me actually. So I've been learning from him. Yeah. So, and I think so, I think I forget who was here. Who was it? I think one of you here, I spoke to you guys during the Viva. You are like a hardcore fundamental analyst, right? I forget who it was, but one of you here also was telling me that you do a lot of research and all of that. So I forget who. So a bull run, not next bull run is happening. We'll have to see when it'll stop. Okay. All right. Now let's look at the last three, and I will focus on one risk, which I think is going to be very important for you guys in the long run. Okay. Now let me ask you a silly question. Is your reputation important to you? Okay. Now my question is why? Like, who cares? Now, do you care if I have a good reputation? I think most of you think you might think of me as a bad person, but that's fine, right? No, forget goodwill, Prabhakar. I'm talking about you, Prabhakar. Why do you feel your reputation is important for you? But Saneen, see, when you talk about self-esteem, right, that is how you value yourself. Now, Saneen, do you really care about what, let's say, Prabhakar
But
thinks?
reputation is good, then we can.
Sorry, Vatsal, go ahead. Vatsal, can't hear you. Okay, I think we lost him. No, but Sunny, let me ask you a question. See, look at the word that you typed, self-esteem. That is how much you value yourself. Now, let me ask you a question. Do you really care what Prabhakar or Anupam or Saurabh or me or anybody in the world thinks about you? Yeah, see, Bhargavi answered the question for you, right? Right. So, see, ideally, most of us don't care what other people. So, and here's the thing: most of you, since you're in your early 20s, right? You still care a lot about what other people think of you, and you're interested in the social dynamics and being popular and all of that, right? But as you get older, right, you honestly will not care about what people think of you, right? And I've had students come to me and say that they've told me that I'm dash dash. I'm like, okay, dude, I don't really care. That's fine, right? And I've had students say that they've come and told me, Rakshit, I think you're a bad person. I think you're this, you're that. I'm like, okay, I'm sorry. I mean, I don't apologize, but I'm saying, yeah, that's fine. I can't really, what is it? Be nice to everybody, right? I am nice, but then I don't have to be nice to everybody, right? So now, why does reputation? So now, Prabhakar, you said it doesn't really matter. Yeah, in terms of what other people think. But now, here's the thing, right? Why does reputation really matter? Is because at the end of the day, we live in a society, and tomorrow, if let's not only a job, right, but it could be any aspect of your life, that if you have a good reputation, people will value you. Okay, not maybe more or less, but they will assign some sort of value to you in their head, and there'll also be a level of respect that is given to you. But if you have low reputation, will you make a lot of friends? But you might have friends who have low reputation. All right. Yes, it'll help you to increase your network. And for example, right now, let's say that there's 24, 25, yeah, getting a loan in civil score. Yeah, that could also be it. But let's say, there's 23 of you guys here. And let's say that you guys keep in touch or whatever, like, and 2 years later, right now, let's say you guys have had a good interaction with each other. Or let's say, for example, I'll take Vatsu, like, he's interacted with with one another person really well and all of that, and then Vatsal asks, hey, you know what, I'm looking for a new job, could you help me out? Because you had a good experience with Vatsal and you feel that he has a good reputation, you will want to refer him to your company, like that. Okay, so now how does this matter to a financial institution is that when you look at reputational risk, right, reputational risk you cannot hedge against. See, if you have market risk, interest rate, price, you can hedge. But can you really protect your reputation? Now you can, well, you can to a certain extent, but from a company perspective, because see, a company comprises of thousands of people, and let's say you have like 10 people who are really bad, and could they ruin the reputation of the company?
There is one thought also that if reputation is lost, then everything is lost.
Exactly. So when you talk about reputational risk, right, it actually causes a bigger damage to the company than anything else, right? And I'll give you guys an example, right? With one of the investment banks, right? The client called up the one of the investment banks here in India, and the analyst, right, did not say good morning, how are you, and all of that. Now, sometimes some clients are a little too much, okay, but what happened was that the client got really irritated and it's like, hey, why can't you just wish me good morning and like how are you doing and all of that. Now maybe that person didn't know that they're calling India, and in India it's in the evening. So why, if somebody's called in the US is saying good morning to you, but it's night for you, will you also say good morning to them? Probably not, right? But then the client got so irritated, it's like, okay, I'm not going to do business with you. Then, the manager stepped in and said, hey, hang on, man. Okay, I apologize. My analyst maybe was not courteous to you, but you got to understand that it might be 8 a.m. for you in the US, but it's 8 p.m. here. Why will anybody wish you good morning when it is night here? So then they kind of understood and they apologized. But a small thing like that, right, could damage the reputation of the company. Okay. Now, and if you guys have noticed, right, for example, the Punjab National Bank Nirav Modi scam, what happened was that a lot of people started withdrawing their or closing down their accounts at Punjab National Bank, right? Why? Because the reputation was damaged, right? And would anybody, and does and now let's say tomorrow, with let's say some bank, there's a scandal and you have an account with them, would you keep that account or would you close it down? Yeah, exactly, right? You'll close it down. You don't want to be associated with that. Or what if you find out that a bank was helping terrorists launder money? Would you be very happy with that? Obviously not, right? So that's where all this is coming from, guys, is that reputation is massively important, not only for a financial institution or for any company, but for you as well. Okay. So now let me ask you, so largely you cannot hedge yourself against reputation damage. Okay. Now you can, ideally you will not destroy your own reputation unless there's something wrong with you. But what would happen if somebody damaged your reputation? What should you do? Do you guys know? If let's say there's some person who says bad things about you and everybody ends up believing it, and you cannot show proof or you cannot justify, what will you do? Is there anything that you can do?
We'll hire a PR team.
You will hire a PR, Vatsal. Now, let's say, Vatsal, like in the company that you're working, somebody doesn't like you and they say, bad things about you. What will you do? Now, will you be able to defend yourself? I mean, maybe, yeah, you could. Sorry, maybe, right? Maybe you can this thing. Now, ideally, what Akib is saying is spot on, right? Unfortunately, nothing can be done, right? See, Anupam, defamation lawsuit and all of that, do you think that'll work in India? Yeah. I mean, you can try it, but I don't know, right? So, well, I actually agree with Akib on this is that if your reputation is, you know, destroyed or somebody ruins it, right? Just leave. Yeah. Honestly, just leave, start over, go to a different company, relocate to a different city or a state.
No one believes them, so no one believes us.
Yeah, because nobody is going to
Just
believe you, right?
waste of time.
Yeah. So, so that's when we talk about reputation, right? That's why it's very, very important to have good reputation. And if in case it is ever messed up or destroyed, right, you please leave. Okay. Now, let's say it's specifically somebody who did this to you. Now you can maybe file a lawsuit and all that. But I prefer, maybe after quitting and all that, find out where the guy lives and, take a few of my friends. Actually, Preetham, I would say it's your first option, not your last option, right? So if somebody did that to me, I would immediately quit, find out where the guy lived, and then, say hello to my cricket bat.
How about
Sorry?
before quitting?
Sorry?
How about doing this before you quit? So like talking to the guy directly with a couple of your friends or whatever. So you don't have to quit, and probably you can undo that.
No, so here's the thing, right? Problem is perception is reality. Okay. Now, what do I mean by this is that if somebody says something bad about you, and you know what, believe it or not, people are very, very gullible and they're very easy to convince. Okay, unless they have a mind of their own. Okay. Now, if you have a large group of people who, now let's say, for example, Anupam, let's say it's your boss. Okay. And let's say your boss bad mouths you in front of your, or keeps saying bad stuff about you to the entire team. Now, who will take your side? Will your team members take your side or the boss's side?
And it's obvious.
Yeah. So that's what I'm saying. Now, if it's like a junior person, let's say your colleague or something, Anupam, then yeah, pull him aside, talk to him, figure it out. Maybe a few, a little bit of a punch in the face and all that might sort out the issue. But if it's somebody who is keen on destroying you, right, then there's no choice left but to quit. And I'm sorry, we're going off topic, but I think then you really have no choice. Yeah, quit, then find out where he lives, and do cricket practice. Yeah, I'm just joking, by the way, right? But that's the idea with reputation, right? Is that you cannot, what do you call it?
But
Protect,
sir,
not really
sorry,
defend
I'm
yourself.
going off. I'm going off topic right now. But there is one bank in India that everyone abuses and say they have worst customer service, but still maintains a one account in that bank. That is SBI.
Yeah, true. Because that is more to do with sentiment. That's more to do with emotions. That's why. But by the way, SBI's technology has really improved compared to a lot of the other banks. Like their online portal, right, is amazing. Even I have an SBI account. Um, you know, uh, so their online portal is really amazing, actually, really, really good. They provide a lot of services and all of that. Yono app. Anupam, very lot of questions here. What if this follows to the next company due to references that they might need? So Anupam, in this case, right, I would always suggest that if you have, so you don't have to, let's say, give your boss as a reference, right? You can always give your friend or somebody who you're good with as a reference. Generally, companies nowadays don't really do references, okay? But you don't necessarily also have to give company as a reference. You can also give, let's say, your client as a reference, etc. Yeah. So I hope nothing like that has happened in Anupam, but yeah, I do understand the concerns around it. But so, for example, right, like if when I was in SocGen, right, I had a very bad relationship with my manager. Now, I will, and when I joined Emarticus, right, I never gave his name. I never gave his name as a reference because I know he will badmouth me. But I was in very good books with my director, okay, who is like 4 or 5 times senior than my manager. So when I gave the details, right, she gave me a very good feedback, right? So that's why have at least 2 or 3 people that you're good with. That's generally the this thing. Yeah. Now SPI don't say. Yeah. Okay. All right. So sorry, off topic, but I think reputation is always a fun discussion for me. Okay. All right. Now let's look at the last 2, systemic risk. Okay. Now systemic risk is also known as a domino effect. Okay. And I think a good example is COVID and 2008 financial crisis, where one thing happened which led to a total and almost complete collapse of the entire financial system. So when you look at systemic risk, right, if things don't go, if one thing collapses, there's a very high chance that everything will collapse. Okay, so and largely with this, right, there has to be strong regulations in place. People should be doing their job ethically and legally, etc. So sort of not ransomware. Okay, ransomware and all is like an attack. Okay, but here I'm talking about, let's say, another 2008 financial crisis, which literally brought the entire financial system of the world and the global economy to its knees, right? Now, if the governments hadn't bailed out the investment banks and all that, we would have still been in a recession, right? Even though it would have been 12 years later. But a systemic risk is very, very scary. And that's like the doomsday scenario types, like worst case scenario. Okay. All right. Now, the last one that it comes under what regime? I don't understand. Ransomware, those are more of technology attacks. That would come under operational risk.
Sorry to interrupt. I just want to ask in which risk type it comes.
Ransomware would come under operational risk.
Okay. Thanks.
All right. Yeah, I'll explain. Okay. So and so guys, let's understand one thing. Irrespective of whichever bank you join or whatever it is, right? So you will join, let's say, a fixed income settlements team or a derivatives team. That is your job function. But what you are going to be doing in that job is operational risk. Okay. Operational risk is going to be the most important thing for you guys. And this is what will gauge your success in an investment bank. You see, somebody was asking, is it target based or quality based, right? So when we look at, and that's why I mentioned quality based, right, is because when you look at operations, right, you are processing information that has already been done by somebody else. And your job is to move it to the next person, or to the client, or whatever it is. Okay. So when we look at operational risk, right, this comes out of technology errors and human errors. Okay. So I'll give you guys an example, right? So this happened in one of the investment banks in the FX team. Okay. So actually FX team, and I'll actually be, this happened with Deutsche Bank, actually, I think in Bangalore. they were supposed to make a $1 billion, and this was public news. It was on what is it? CNN about 2 to 3 years ago. So DB was supposed to make a payment of $1 billion to client A, but by mistake, right, they made it to client B. And this was on CNN. DB makes incorrect payment of $1 billion to the wrong client. So this is operational risk, where you, a human, okay, we're all human, yes, made a mistake, and because of this, right, it caused an error. Okay. Now, believe it or not, operational risk, right, on a yearly basis, the amount of human and technology mistakes that happen is somewhere, I think, around $150 billion across the financial services industry. So humans and technology, bad combination, I know, but when you put them together, they approximately make $150 billion worth of losses to the company. Right? Now, what are these losses? So, for example, you are supposed to make a 10.
Saying about technology.
Sorry, Vatsal, say that again. Vatsal, I can't hear you. Type it. Okay, so
I said
go ahead. Go ahead, Vatsal. Go ahead.
I can understand about human errors. What is the technological errors you are saying?
Okay, I'll tell you.
Technological.
Yeah. So let me give you an example of a human error. Okay. Now let's say that. So this happens a lot. Okay. Was that let's say you have to make a $10 million payment to your client. Okay. So how much is that? That's 3 zeros, another 3, 6, 7 zeros, and 1. That's $10 million. Sometimes what used to happen, right, in a lot of the places, the analyst by mistake would add an additional zero. So then what happens is your $10 million becomes $100 million. Yeah. So this is a human mistake. Okay. So, and these are the kind of losses that we're talking about. Okay. Now let me talk to you guys about technology errors. Okay. Now you got to understand that, see, at the end of the day, even the programming, the base programming or the code that is written is by a human. And humans obviously are not perfect. We do make mistakes, right? And there is an entire process in place where it's the code is verified and there's UAT testing, all of that. But still, there could be something that goes wrong, right? There could be something that goes wrong. Okay. Now, I'll give you an example. Okay. So this happened in Royal Bank of Scotland. Okay. Actually, one of my students was telling me about it. He was on the tech side. So that what happened was that, do you guys know what is batch processing? So batch processing is not real time. That means that a certain number of cases will come, it'll create a batch, then it'll get processed. Like for example, NEFT. NEFT does batch processing. So a bank will receive like 10,000 payments, then it'll get processed one shot. But RTGS is real time. Okay. So what happened was that in Royal Bank of Scotland, I think, is that this was on their retail bank side. And what happened was that there was a system end of day run was happening. And what happened was that one of the batches failed to run properly, but the tech guy did not notice it, and the entire process got completed. Okay. Now what happened is nobody picked up on this error, but automatically the system, right, in the back end, what it started doing was that it started automatically posting onto the client's account saying that their credit cards were paid, but they actually were not paid. So can you imagine this, right? Is that, let's say that you have a Royal Bank of Scotland credit card, you charged £1,000 on it, and then you don't get this, you get a statement, but you're saying that you've already paid. Now, initially, and tell me, if you have, let's say, charged, let's say 1 lakh on your credit card, but then it comes to you saying that you've already paid for it, will you call the bank and tell them, hey, I think you made a mistake? Or will you be quiet?
Party time.
Sorry, you'll call the bank.
Party time.
Yeah, you'll be very quiet, right? Yeah, so that's what happened was that. So, so all this work was happening. And then after a few weeks, right, and literally it took like 2 weeks for them to find this mistake. So customers started calling, hey, and they said, you know what? I noticed, see, I charged my on my credit card, let's say £500, but it already says that I paid, but I haven't. Can you double check? Then they were like, what happened? We'll figure it out. So they actually checked, and then they realized that because that batch process had failed, the system automatically posted credit entries onto client's account because that batch failed. Now, believe it or not, the loss suffered by this was close to £12 million. Okay, £12 million loss was faced by Royal Bank of Scotland, 12 to 15, I think, something along those lines, because the IT guy was not keeping track of the batch processing. Yeah, wrong entry. Yeah, so it flipped from a debit to a credit. Right now, what do you think would have happened to the IT guy? Is the question. What do you think would have happened to him or her? Who knows? Yeah, fired is minimum. No. So Saurabh, so one thing that you guys will be a little bit happy about, I don't know, is that in an investment bank, actually, let me put it this way. So for a lot of you guys who don't work in retail, right? So in retail banks, one of the rules is that if you make a mistake, you have to pay from your own pocket. Okay. But in an investment bank, see, because of the volume of the transactions and the value of it, there is no way you're going to be able to pay 15 million, right? So Saurabh, if you made a, let's say, 15 crore error in the bank that you're working in, will you be able to pay it back? Right? So in an investment bank, yeah, smile, resign, yeah, smile, resign, run away, and go to a non-extradition country and work as a bartender, right? So yeah, that's where it comes down to, right? Is that in an investment bank, you will never be able to pay back these things from your own pocket, okay? So that's a good thing, obviously, but then you got to understand that your career will take a drastic hit if you can make these kind of mistakes. Okay, so the idea that I want you guys to understand here is that when we talk about operational risk, you are being hired as somebody who's going to, let's say, do equity settlements or derivative settlements or trade confirmation, etc., right? So you are going to be managing the risk around that process. Okay, so essentially all of you are risk managers. Now, I'm assuming that all of you want to get promoted. Yes? Promoted, hikes and bonuses, etc. Obviously, right? Who doesn't? Okay, now how one of the easiest ways to actually grow in a financial institution, and that too in the operations side, right, in the ops side, is to reduce human and tech incidences. Okay, human and tech incidences. Now, what do I mean by this, right? Is that now let's say that you're in the equity derivatives team, like let's say you're in a futures team. Now you realize that, hey, you know what, this process that you're doing is not very logical and there's too much manual work, etc. How can you automate it, right? How can you automate it? And how will you be able to reduce that risk? Because see, as long as a human is involved, there is a possibility that a error will happen. Now with technology, the error might be less than 1%, but with a human, it's going to be it's going to be much higher. Okay, so what you need to do is you need to identify what are the things that you can automate. Okay, and work on that automation and reduce the risk to your team or your department, and that is how you are going to get promoted. Your awesome hikes and your bonuses, etc., is what will happen if you can reduce operational risk. Okay, now what I want, so how I would actually envision it for you guys, right, is that take about a year and a half to learn your process thoroughly. Now I'm giving you an extreme case of 1 year, 1.5 years, because everybody learns at a different pace. Okay, so a year, it maybe takes you a year and a half to understand everything. Okay, and it will take it might take longer, or it might take less time as well. Okay, but on an average, it'll take you about a year and a half to understand everything. And once you've understood everything, right, figure out what are the things that you can automate. Okay, and this is where having a good network, okay, with technology people, with uh, who else, technology people, other people in operations, your management, etc., right, is that you can be able to figure out these problems, and you'll be able to solve them. Okay, and once you start solving problems, right, once you start solving problems, that will be the reason why you will start getting promoted. Okay, now you might think, now the next question you guys will have is, hey, you know what, I'm a new person here. There are people who've been in the team for 4 or 5 years. They should be able to figure out this. Well, true, but you know what's surprising is that most people will just come to work, do their job, and go home. And please understand that you're being hired to do this, in terms of come to work, do your job, go home. Okay, and if you do your job well, then you have your job. If you don't do your job well, you're fired. But if you want to get promoted, what do you have to do? You need to outperform everybody else. So one of the ways to outperform is to reduce your operational risk. Okay, and trust me, there are a lot of people who will not, and who won't do this, because why? It is additional work. Okay, so let me guys give you an example. So when I was in Goldman, right, we used to do 10-hour, like minimum 10 hours. That was our day-to-day work. Now if we had to do any projects or anything like that, right, we had to stay back and do it for additional 2 to 4 hours, and we used to come on weekends. Now who are the ones who will do this, who will stay back for an additional 4 hours, come on weekends and work? Will everybody do this? What do you guys think?
Selected few.
Sorry?
Selected only few people.
Only a few people. Now who are these few people? The ones who are highly motivated. Okay, who want to make it big in life. Now see, there's nothing wrong against people coming, doing their job, and going home. I actually like those kind of people, because I don't have to promote them. Right, I have to worry about my star performers, right, and my star performers are the ones I'm going to promote. I'm going to give them the hikes and the bonuses. But the people who are average, will I really be bothered about them? Now an average person, can they be replaced easily? Very good, Prabhakar. Yeah. So see, and it's not to like uh, make you guys feel bad, right? But even for a very long time, I was a very average performer. Okay, I was a pretty average performer. But then I got tired of people who I thought were not capable getting promoted, getting the big hikes and the bonuses. I was like, why is this person being promoted when they can't speak 2 words of English properly, right? So once I understood, and because they were doing their job differently. Okay, they were looking at operational risk. They were on the good books of the managers, etc. Okay, and once I started doing that, right, I got growth, right? So one of the ways that you guys have in front of you is by reducing your operational risk. Okay. Now, can you do other things? Yes. If you're good at politics, maybe you'll do that. Okay. So I'm not giving you the right or wrong answer. You do whatever you think is right, but you got to understand that at the end of the day, especially in the world of finance, those who have a keen focus on risk and are able to reduce risk are the ones who will move into top management. Okay. The guys who play politics, all the drama and nonsense, right? They will grow to a certain extent, but after a while, right, they're all going to fade away and burn out. Again, especially during COVID, right? Like my friend, he actually called me a few days ago. He told me all those guys who used to play a lot of nonsense, right? They all got fired because you have such a huge situation happening. Everybody's working from home. Nobody's understanding what to do, and this guy is playing. A guy or girl is playing stupid games. So we don't need those kind of people. So that was one of the interesting things that I learned recently, is that those guys kind of got thrown out. Yeah, but there's no right or wrong way. But one of the good ways is by managing operational risk. Okay.
Hello.
Yeah, sir. Go ahead.
Yeah, only two questions. In Hyderabad, recently rainfall happens, so due to which my the operation wasn't working for 2 3 days. So
Mhm.
that comes in the operation as the time as well.
Yeah, it does. See, because here it says, right, risk of natural and man-made catastrophes.
Okay, and one more question.
Mhm.
That in an IB, is there a maker checker application as there?
Yeah,
Because we do that in I.
yeah, that is also there. So, for example, if you put a $10 million payment, I have to
Mm-hmm.
approve that 10 million. But what happens is that, see, now let's say, Saurabh, let's say you and I have been working together for a long time. Now, will I trust you to
Yeah,
do
so
your
you have
job?
trust on me, so you have done that. Yeah,
Yeah,
okay.
and I have, as a manager, no, I've done that so many times. It's not even funny. Yeah, so even I have screwed up a lot. Yeah. So, guys, by the way, I'm not. A
So,
lot of you might think I'm this thing, but I've also made my share of mistakes and all of that. I've also been close.
mhm.
Once I almost got fired. So I've done a lot of stupid stuff. Once I, uh, uh, lost my promotion. Actually, yeah,
Okay.
yeah. What's
Actually, we are working for quite a long time, so that trust level builds up. So you
exactly?
approve that. That
Yeah, yeah, exactly. Yeah, yeah, but so many times I've witnessed it, and I was also part of it as well. I don't want to like kind of talk about it because it'll bring back nightmares. But yeah, I have been part of that this thing. Yeah, been part of that. It was not fun. Okay. No, no. See, there's nothing to be sorry about, Saurabh. It's the part and parcel about working. See, every job has its risk, right? And in an investment bank, the risk is magnified because you're dealing with a lot of money, right? But then if you go to other sectors, right, or other industries, they're also. So imagine, for example, right, let's say if you talk about pharmaceutical industry, let's say that the like a particular tablet should have, let's say, 50 like 10 mg tablet, but the person who's working on it by mistakes adds a zero point 0.5 mg, and that gets distributed out to the entire population, right? Now, how difficult will it be to recall those batch of medicines, right? So all jobs and professions have a risk associated with it. So there's nothing to be sorry about as such, but you guys just have to be very, very careful. And here's the thing, you will make mistakes, you will get shouted at, you will feel bad. You will feel like you're quitting. Some of you will, after 2 years, you'll say, oh, I don't want to work in an IB anymore. I will move on to something else. Yeah. So that will also happen.
Actually, I have done that in ICICI Bank as well. One of my prestigious client want a big car. So without the file, they get logins in the system. I send the approval letter to the delivery dealer of that car that this case is approved and you just release the vehicle. And he released the vehicle, and after that case is filed, log in and I disburse it. But if that client back out, then I will have lose my job.
Yeah.
So, but I have trust on that client, so I have released the vehicle.
Yeah, true. Yeah, but so one of the things I'll tell you guys, right? And I love this. So this is one thing that I learned again at Goldman: trust, but verify. Okay, I trust you, but I'm going to always verify what you're doing. Yeah. Yeah. It'll make you tough. It'll make you very, very tough. Yeah. Okay, let me stop your recording. Okay.